Good evening and welcome back to Southbank Live. We're now on episode 23, now into December, and Christmas is approaching us, but there's still plenty of things to be discussing as we head into the end of the year. My name is Boaz Shoshan and I'm joined as ever by John Butler. John, how are you getting on this week?
Yes, very well. Thank you.
Oh, pleased to hear it because it does seem to be a very interesting time for the markets. I can imagine a lot of investors being rather worried about the way things are at this time of the year. It does seem like maybe Santa will not be arriving to save the day at the end of the year. But there's plenty of things to discuss, John. And to everybody who is watching this, thank you for tuning in. Do feel free to leave your questions or any comments in the chat. We didn't manage to cover everybody's questions in last week's episode, but hopefully we can do as many as we can this week. As it is great to see that we have quite a good audience now. Lots of engagement is great because the whole point of these shows is to have much more discussion ultimately between us at Southbank and our readership and our viewership. So please feel free to ask your questions in the chat. And if you do like the show, please give us a like and a subscribe because it really does help us out. Now, to start us off with this week, John, I thought probably the most pressing piece of market turmoil that people focused on the most was probably the chaos in Bitcoin, where we saw Bitcoin go from roughly 56,000 well down into the low 40s in a very short period of time, as Bitcoin does every now and then, before bouncing back up. And now we've got, I think we're standing around $50,500 per Bitcoin. What's your take on that? Because you and I have quite different views on crypto in general, but in terms of what Bitcoin may signify as an indicator, I think we're both quite on the same both singing from the same hymn sheet, as it were.
Look, regardless of Bitcoin's potential promise, or for those who are skeptical, Bitcoin's longer-term challenges to overcome, regardless of those fundamentals, look, it's something that trades, and it's something that is going to, demonstrate natural market dynamics of things that trade, things in which people speculate. And Bitcoin is still driven, that is the price thereof, it is still driven primarily by speculation. That's just the reality. There aren't that many end use cases yet. There are more than there used to be, for sure. But as a percentage of the total volume that's changing hands day to day, it is still primarily speculation that's driving the price. And again, that's true of lots of things. So don't take that the wrong way. But hence we have to approach the price action from that perspective. And also keep in mind that the bulk of that speculation is driven by a relatively small percentage of market participants who have very, very large influence on the market. And if they're going to enter that market to buy more or to sell what they've got, they're potentially going to move that market. And they know that, right? They know that. And so when you have a market like that, you are occasionally going to get big, sudden moves in both directions, upside and downside. So the best explanation for what happened here, because I don't see anything on the fundamental front that was meaningful at the time, the best explanation is simply one of the big Bitcoin elephants out there decided to sell, right? Decided to take profit and decided to do so very suddenly for whatever reason. I mean, are they simply trying to beat the price down to accumulate more? Just a definite possibility. Are they actually deciding they want to diversify into other coins? A definite possibility. Maybe they're diversifying into other hard assets. Another definite possibility. Maybe they're concerned the Fed and other central banks will indeed start raising interest rates aggressively as a result of high inflation, and they're worried they're a bit over leveraged with respect to their position. A definite possibility. It could be one or all of the above. And that to me is where one would want to look to understand what happened.
Yeah, it is. In terms of the liquidity of Bitcoin, I think it does remain, as much as everyone who believes in the asset and wants it to succeed, it is hard to deny that there is still a liquidity problem. And with the distribution of Bitcoin as it is, where ultimately there are still plenty of whales out there, though you don't hear much from them, you don't really know who they are. If they do want to sell a lot of it in a short period of time, well, they can do an awful lot of damage to the price. But of course, you still have incredibly fervent buy the dip mentality now from a lot of the Bitcoin community, which I find quite interesting. It's a bit like how the buy the dip mentality for the sort of the everyman stock investor, but even more so because in Bitcoin it's called stacking sats, and people love posting on Twitter whenever they stack some more sats, with sats being satoshis, which is the smallest unit of Bitcoin that you can get. I believe 100 millionth of a Bitcoin is one satoshi. That's the smallest unit you can divide it into. Though apparently through smart contracts you can actually divide it even further than that. Though I don't know how it works. But there's this very it's almost, I mean, it sounds very bad, and I say this as somebody who's very much into Bitcoin in general and the crypto space. But there's definitely an element of religion with the manner in which a lot of people view this. But then, saying that, a lot of people are a bit like that with precious metals, which we have plenty of time for here at Southbank. Just looking at the chat. Good evening to those who've said hello. It's great to see you here. Good evening, Helen and Liam and Jason. It's great to have you here. And it's great to hear that people are enjoying these shows. Any suggestions you have for future shows or future topics, do let us know. On the same note with Bitcoin, John, I would be interested to hear what your thoughts is on the entire El Salvador situation. I don't think that's something we've focused on in a great deal of depth on this show. David asks, through all about El Salvador and Bitcoin, which will be the next country to set up Bitcoin, and when will it happen, please? I love what is happening to the poor people out there, and I want to see more of it. It is very interesting to see what El Salvador has done, John. I imagine you're slightly more skeptical on the value in their action so far, though, right?
Well, I'm skeptical because I see a lot of politics in what's going on. El Salvador has a long history of a difficult relationship with the United States, and that is certainly true of the current administration, which was potentially facing dollar sanctions as a result of certain policies. And of course, no country wants to be subject to that sort of treatment. And it seemed a very sort of convenient decision politically for the president to embrace Bitcoin and say, hey, we're going to make this legal tender. In large part because El Salvadorians, they do see the dollar as a better store of value than their domestic currency. And so trying to embrace Bitcoin, in a way, you're killing multiple birds with one stone, perhaps, from the political perspective of El Salvador's president. So don't get me wrong. I mean, he may truly, genuinely, religiously believe in the merits of Bitcoin, but there's clearly a political convenience factor here. And I think that was a big driver behind the decision. So the answer is the next country to go down that road and to make Bitcoin legal tender, in my opinion, is strongly likely to be one that has a challenging relationship with the United States or another country in a position to impose potentially damaging economic sanctions, including potential limited access to the banking system.
Yes.
And if you want to get around that, well, hey, Bitcoin is potentially a way around that. So who could that be? Well, there are other Central American countries that come to mind. And also in South America, there are a couple of countries that come to mind. And then, of course, as you cast your net wider around the world, let's face it, there are, I think, what is it now? Some 36 countries that are already under material U.S. economic sanctions as I speak. That would be the short list, right?
Yes. And on that note, John, there has been a lot of chatter this week about the US making another move to sanction Russia via the SWIFT system. Would you like to give us a little bit of insight on that, a little bit of background to it?
Look, I've thought about this topic a lot. I've written about this topic, and I'm not the only one. I mean, some people have practically made a name for themselves on this topic alone, although Jim Rickards comes to mind. I mean, he's written very, very extensively about this. And look, the fact is that Russia is arguably the single biggest country out there that has perennially been the subject of this or that form of U.S. sanctions, and which has taken very concrete steps through the years to try and insulate itself from that as best it can. Part of the reason why Russia and China have cozied up to each other to the extent they have is because they kind of see a common threat of U.S. sanctions, be it simply trade disputes or be it something more heavy-handed, such as cutting them out of the Western banking system, which, of course, SWIFT is the clearinghouse for that. So Russia has, look, they've kind of seen this coming. Does that mean that it wouldn't be disruptive were the U.S. to pull the plug? Absolutely. But Russia's better positioned than any other large country to deal with that. And I suspect, although it's not public, of course, I suspect there is indeed some plan hatched by Russia, China, possibly India and Brazil through the BRIC dialogue to work together in bilateral trade, including bilateral use of each other's currencies, in the event the United States does go down that route. The fact is, if the US can do it to shut Russia out, they can do it to shut all of them out. And I suspect they would draw a line there, close ranks, and try to get the US to back down, and quickly, if indeed it came to that.
You say Russia is the best equipped to deal with that kind of scenario, John. Could you expand a little on that? How is China, for example, not more well equipped?
Because China has not gone to quite the lengths that Russia has to divest itself of dollar assets. And that includes the use of dollar assets as collateral within the domestic banking system.
Right.
And also Russia's gold reserves as a proportion of their money supply and their sovereign debt is so much higher, but at least based on official data. And there are unofficial estimates, but even they don't place China's holdings of gold as a proportion of Chinese financial assets and money supply. It's not the same order of magnitude. Russia has really built a moat, or a wall, as it were, in preparation for the possibility that it does get shut out from the international financial system, and indeed that it simply has to retreat into a somewhat autarkic economic situation. That means, of course, you just don't trade, right? You're just shut out, full stop, from the rest of the world. Russia is a pretty well diversified economy. They have all the energy they need. As we know, they're a huge exporter. They have the ability to refine that energy into whatever form they need to. They used to require a lot of food from the rest of the world. They don't anymore.
No.
Although that said, it depends on the seasons and the weather. It can be challenging for Russia, but they're less dependent on the rest of the world for food imports than they used to be. So, I mean, they've come a long way, as it were, in building their resilience to these hypothetical scenarios.
Yes, certainly. And on that note, John, if I could, when we're thinking of SWIFT and the SWIFT system and America's role over it, some folks tuning in may not be familiar with SWIFT or what makes it quite so important. From my understanding, if I recall, SWIFT isn't based in America, is it?
No, it's based in Belgium.
Yeah, and yet America seems to have some kind of control over it when it comes to clearing dollar payments. There was a very interesting story a little while ago where I believe it was somebody in Germany selling cigars to somebody in Denmark. It was one of the Scandinavian countries, and they were Cuban cigars, and it was just it was completely within Europe. But the payment was locked down by America through the SWIFT system. So the person was just spending their money online. It had to go into dollars because it was going across currency. I believe from German euro through to the krona, and because it had to go through the dollar in the middle, there had to be a US bank that facilitated that. Somehow or other, the U.S. bank, flagged it up. Oh, these are Cuban goods. These are Cuban cigars, and well, it was locked down. So I don't think the person who actually ordered it, I believe it was a policeman, ever got his cigars or his money back. And it was one of these very strange scenarios which showed how the global financial system, even if you're not in America, even if you don't think you're using dollars, can be weaponized and used against you. And it creates all these very strange scenarios. Could you just give a little bit of background on SWIFT and why SWIFT is so important to the global financial system, and why, despite even being outside of America, America has so much control over it?
Well, it's the international clearinghouse between banks across borders, okay? And so it's where the payments are cleared as you move between one country, a bank domiciled in one country using one currency, and a bank domiciled in another country using another currency. SWIFT it all goes through SWIFT. Now, that said, depending on the currency in question, of course, it also is going to go through someone's central bank. And so in theory, right, the Fed sees everything it chooses to see. And the same is true of the euro with respect to the ECB and other central banks. So it not only goes through SWIFT, but it's also going through the central banks. And so, look, this is one of the problems that Bitcoin, in theory, was designed to solve. The idea that if you have a sovereign currency, you are in a way sovereign over any and all transactions in that currency. And if you disapprove of the transaction, you can effectively block it. Now,
No
that's
doubt.
you got to get ahead of it, right? But once you do get ahead of it, you can shut down a given account, a given bank, a given country's use of that currency. So it's not just the US that has that power over SWIFT with respect to its own currency, but what makes it so dominant is the fact that the dollar is still by far the dominant international transaction currency, regardless of where you are. I think it still accounts for over 70% of global transactions that cross any sort of border out there. So everything else, right? Chuck in the euro, chuck in yen, chuck in sterling, and so on, and they account for less than 30%. And that is a weapon. And the US does wield that weapon now and again, but every time it does, it's teaching one or more entities out there a lesson that they might want to find an alternative in case the US gets aggressive in future and prevents them being able to engage in whatever trade or investment flows they deem appropriate for themselves.
Looking at that, John, because you say how ultimately any currency, any sovereign currency, if it's going through SWIFT, if it's being used for international transactions to some degree, well, then that state can do something to intervene if someone else was using that currency to do something that they don't like. Has any other country actually done this? Because as you say, the dollar and America is the most dominant because the dollar is the global reserve currency. But, I don't think.
Well, I mean, the ECB effectively did it right when Greece was potentially leaving the euro, right? I mean, the ECB basically shut that down. Now that was a more direct relationship; it wasn't via SWIFT.
Yeah, right. Via SWIFT.
But in theory, that would have been the next step. That is, the first thing you do is you stop accepting Greek bonds as collateral, which sends Greek interest rates soaring. But to the extent Greeks were still using the euro for this, that, or the other thing, the next step, the ECB wanted to, they could have shut any Greek domiciled entity from transacting in euros. Full stop. Chaos, right? I mean, they never had to play that card because Greece backed down. But in theory, that was the next step in the escalation that they were threatening to do.
Yeah. My question was specifically with SWIFT. If there were other countries that have gone through use the SWIFT route, yeah. But I agree.
I don't believe so.
Same intention ultimately when you're threatening to not accept other countries. That's one of the strange things about the eurozone, isn't it? It's the same currency, and yet certain countries, if they wanted to, could stop other countries from using it against their will and things like that. Now, I do see there's a little bit of activity here in the chat, a bit of arguing going on. Come on, folks, be nice to each other. It's not we're not here to fight. We're here to have a nice discussion. But just taking a look through here. Now, I'll put you on the spot here, John. Another one of these prediction for Bitcoin by the end of the year. This comes from Damien. So, exactly the kind of question that John wants to answer on a fine Wednesday evening.
The problem forecasting Bitcoin, and don't get me wrong, there are people who have created models that they believe are able to predict the medium to long-term development of Bitcoin's value. And they come up with various metrics that they use. And I mean, look, more power to them. Why not give it a go? But if you're talking about predicting it on any shorter term time horizon without some longer term fundamental concept of what it should be worth, it really becomes a big guessing game. And the reason why is not only that Bitcoin is volatile, it's that you can also make the case that Bitcoin's distribution isn't normal. And indeed, no one really knows what Bitcoin's price distribution should be. Should it be normally distributed or not? Now, I mean, assets price distribution is generally normally distributed, but even there, you have fat tails when it comes to financial crises. And in Bitcoin's case, because it is not primarily used as money. It's used primarily as a source of speculation, and there is no there's no there's no requirement that people hold it. It's purely voluntary. It's difficult to really say that we know what price distribution it should have. Should it have fat tails? Maybe, maybe not. We just don't know. There's too much pure uncertainty. So it doesn't, in a way, it doesn't matter how volatile something is if you know what distribution to apply to it. But we don't know that with Bitcoin. So, I mean, it's pure finger in the wind stuff for me anyway. That's and so, where do I think it's going to be by year end? Best guess is where it is today, in my opinion. But again, that's just a guess.
There you go, Damien. I don't think you're going to get exactly what you're after out of that question, but it's just that's the nature of the question. It is what everyone would like to know. Ultimately, if we did know and we'd been able to get it right a few times in a row, we'd all be incredibly wealthy and have a private island in the Bahamas by now. But of course, we ultimately don't know. Jill asks, hello, good evening. With all the money printing and inflation, surely Bitcoin is the obvious answer. Gold 2.0. Well, this is John. I imagine you've counted this quite a lot, specifically the gold 2.0 argument. And I'll let you give a reply to that. I think your description of it to me before as well, one has to recognize that one of these things is made by man and thus is fallible, and gold is not made by man and thus does not have the same issues.
Look, I mean, that is of course the most important single qualitative difference between Bitcoin and gold. That said, when one reads the original Bitcoin paper, it's very, very clear why the terminology is chosen as it is, to very, very much be based on the concept of gold, right? Limited supply, and calling it a coin in the first place. Coin is not paper. Coin implies metal, and historically, of course, the metal that we associate with money is primarily gold, although silver, of course, has played that role, and at times copper and other metals, but gold has always been the king thereof, as it were. And so there's a reason for all of this, but the single biggest difference is that, notwithstanding Bitcoin's limited supply, of course, there is a theoretically infinite number of competing coins that may have algorithms very similar to Bitcoin, may have algorithms somewhat different. But what all those algorithms have in common is what you said, Boaz. They've all been created by man, and they all need to run on some sort of network. And that network is going to need to consume energy to process transactions, and someone is going to have to pay the costs of processing those transactions and maintaining that network. Now, of course, I mean, if you're going to use gold as money, you also need to have a network. But the nice thing about gold is that in of itself, having been created by the universe, Mother Nature, God, call it whatever you want, doesn't require any energy at all. Gold is uniquely non-reactive. And so that means that the storage costs for gold are the lowest of any substance in the known universe. Whereas keeping a server cool and operating efficiently with minimal energy input to support the Bitcoin network has a higher entropy cost by definition. There's just no way around it. Now, don't get me wrong, Bitcoin carries with it other potential advantages, but like for like, Bitcoin as a network is more expensive to maintain than gold as a network. And it does bother me when people say, oh, but gold is heavy. It's difficult to move it around. Why move it around? It can still be the basis of a monetary system, and it need never move. And that's a point that monetary economists going back, generations have made regarding the way, in fact, a gold standard operated. Gold rarely moved, and it was usually only a very small portion that did. So anyway, it's a bit of a fallacy to claim that gold's heavy, it's difficult to move around, or that it's expensive to mine. You don't need to mine gold. The gold's already above ground; it already exists. You only add to the supply when you think it's economically attractive to do so, and it's only attractive to do so if gold appears undervalued relative to other assets. So there's a natural market equilibrium dynamic there that maintains the stability of the system. In any event, look, I wish Bitcoin luck, but it's got a long way to go to establish its monetary credentials.
Yes, I do agree with much of that, John. I do, but I think a lot of people who are trying to say that the two assets are in competition with each other are generally, I feel the argument is barking up the wrong tree. because ultimately they're not the same thing.
No.
And one of them is, one of them's a network and one of them isn't. So it does seem like because they're two niche assets and they have very strong communities. People are into gold and people are into Bitcoin. They really do love their gold and they really do love their Bitcoin. And it's a bit like football, where they offer. But imagine it wasn't football. Imagine if it was two completely different sports, and the people thought they were rivals and they were comparing scores and things like that. That's probably the best metaphor I have for the way we see it. But there's no need. I don't think there's any reason to specifically, you have to be one or they have to be the other. You can like the case for both, and I think they complement each other quite well as a result of their differences. But that's just my view. Now, Liam asked something. This is changing tack slightly here. Liam asked, I know somebody who only trades oil and nothing else. Can you trade the currency market just by speculating on the same two currencies, the same currency pair, all year? Thanks, Liam. Well, I believe there are some people who do that indeed, John. They get really obsessed with their one specific currency, the way it trades. They start dreaming about the yen or the baht or whatever, and just the manner in which it moves, its behavior. They become very, very sensitive to the manner in which government officials speak of monetary or fiscal developments. They get really, really good at decoding what exactly each government official means when they're talking about where the interest rates are going to go and what they're going to do with trade and how strong the economic figures are. And they're tuned in to every GDP announcement, et cetera, et cetera, et cetera. And for some people, it really is a bit like an obsession. I mean, they get so into this one currency and the idea of the currency and the behavior of it. Have you met many of those during your times on Wall Street, John?
Oh God, look, I mean, the fact is, if you're going to be a professional currency trader for, even a small financial institution, be it a bank or other sell side institution on the one hand, or some sort of investment firm on the buy side on the other, specialization is absolutely essential. And there are people that trade multiple currencies, but as a general rule, you tend to specialize in a very small number, and in some cases only a single currency pair.
Yep.
And the currency pairs, as a general rule, are always paired up against the dollar. There are some crosses that are reasonably liquid. For example, euro sterling, right? That's liquid. Or euro yen, that's liquid. And to be fair, sterling yen is kind of liquid too, but the vast majority of currencies are paired up with the dollar itself. And then if you need to do a cross trade, that is two sides of it, to get from the starting currency to the ending currency with the dollar in the middle, then fine. You work both sides of it if you need to. But yes, specialization is the norm, not the exception. That said, there are some people who trade simply based on momentum, or who trade simply based on technical signals. And because those momentum or technical signals can be generated by any underlying currency, they'll trade anything that ticks the box. And there are some hedge funds, indeed some hedge funds with billions under management, that do precisely that. They are agnostic as to what currency pair it is. They don't really care what the fundamentals are. They're looking for chart patterns. They're looking for statistical patterns that generate trade signals. And I know people involved in that side of the business too. So that's kind of the way it works. You have a lot of specialization. But to the extent your trading is based not on fundamentals, not on making a market in a specific currency pair, but rather generating generic signals out of again, various technical indicators or statistics, that could be anything.
Yeah, though generally, from my understanding at least, John, with technical analysis, the signals that are given by charts with classic patterns and that, they're more trustworthy the more liquid the asset is ultimately, because just from the sheer amount of trading. So the less liquid,
look, I know you say that, and I agree with you, but there are a lot of people that somehow think that charts are just the Bible, no matter what the underlying is. And this goes back to trying to understand, how Bitcoin's going to trade, where it's going to be. The fact is, liquidity in Bitcoin is just not in the same league as major currencies. The market cap of Bitcoin is deceiving, because only a small portion of that really moves on a regular basis. And that small portion that moves on a regular basis is dominated by a relatively small number of players. It's just not the same sort of liquid thing that you can compare to major currencies, major interest rates, major equity markets, and so on.
Yes, I agree. I agree 100%, John. I like in terms of looking at Bitcoin, where you see major moves, and it's easy to point out that, oh well, something has definitely happened here. When it comes to classical technical analysis, I don't think it's a contrarian kind of take, because everyone in Bitcoin really loves looking at charts and drawing wedges and flags and everything. But I don't feel technical analysis of the classic.
No, I'm with you. I'm totally with you there.
Yeah, I don't think it applies that way. It's funny how we're talking about specialization. A few years back, I remember meeting a chap at a Bitcoin conference who was a former rates trader. He used to trade interest rates, and I'd never heard this before. But I didn't know in rates, when you're going through the different tenors, so the different lengths of the durations of the bonds, rates traders just really like one tranche of the interest rate. So this
at
guy
at the short end, very, very much so. The farther you go out the yield curves, someone who trades 30-year debt, chances are they're also trading 20-year debt, maybe even 10-year debt. But once you get 5 years or less in maturity, the specialization really kicks in. And that's just because those rates are that much, the flows are that much larger, and rates are that much more volatile potentially at the short end. And so, yes, when you get into the the colors of the euro dollar strip, or the euro yen strip, or the euro strip, as they call it, you get into the reds and the greens. There are people that literally will only trade the reds or only trade the greens, and that's normal. Yeah.
Yeah, can you expand on that for some of our viewers with the strips and with the colors there, John?
Well, yes. Okay, those represent futures contracts, and they represent futures contracts on the major market interest rates. Dollar, yen, euro, sterling, and basically that's the money market. I mean, that is uber liquid. It's the most liquid stuff out there, and so it's trading in volumes that are almost incomprehensible, and in frequencies that are almost incomprehensible. But that's the source of all liquidity. Ultimately, is what's happening there. Right. So you might have long dated bonds, you might have equities, you might have other financial assets that trade. But if anyone is going to trade those other assets, they're trading it against short-term interest rates. And the reason why is because the vast majority of flow out there is leverage flow. Banks who are borrowing short to buy longer dated assets and managing those positions, or hedge funds that are also financing short to buy longer dated assets. That short financing side, that's all being cleared through those futures contracts. It's the common element of all financial asset trading in the world today.
Right. It is one of these things that it seems almost arcane or rather esoteric when it's got the colors, and everyone's looking at future maturities at certain months, and they have their own codes, of course. This chap, I remember, I think he was Belgian, and he would only trade either the Bund or the Boppel and not the Schatz. So short end of German rates he wouldn't touch, but the medium and the longer term he would, and that was the only thing he did. And then high frequency traders showed up, and he got wrecked. Ultimately, they kept stealing all of his money, and then he got into crypto, and that was how I ended up meeting him. But it was one of these interesting things where people get attached and they specialize in specific. It's not even just a currency, but it's specific forms of the currency and specific rates. And it's it's not something that I think most people are totally aware of, as the question would suggest. Now, moving on slightly, we are getting on again for time. Plenty of discussion here in the chat, which is great to see. Robert, who tuned in last week, he's reporting back on some of the investments he's been making. It's very nice for you to keep us informed, Robert. Though I would make sure that if you're buying large amounts of gold, that you might want to keep this more under your hat. But this, he is reporting that he has gone for, he sold a load of crypto, and he's bought some sovereigns, and he is holding on to a lot of cash. And cash is, of course, a good thing to have just in general as an option if you are an investor. It is interesting again. So here we are. It's both gold and Bitcoin and cash in this instance, and not anything else. So Robert here is going for Bitcoin and Ethereum. He likes splitting them and holding them together. I've not heard you comment much on Ethereum, John, in general. Generally, the question is mostly around Bitcoin, because I think Ethereum people aren't quite so rabid on the monetary value of it in quite the same way that Bitcoin is. Is that correct?
Well, I mean, Ethereum is a different approach, right? It's proof of stake rather than proof of work. And
Yep.
look, I mean, there is a long running now, and I would say healthy debate between those who advocate, either or. I mean, at base, right, proof of work is more directly linked to the cost of energy, and it's important that there is some cost to generate and maintain a monetary network, or you end up with an oversupply problem. On the other hand, there's something about proof of stake which is elegant in that the cost of maintaining that network can be finite, and it can be more easily and equivalently shared. That said, it's by definition has at least one, if not multiple, points of centralization, whereas Bitcoin by design does not necessarily have any required points of centralization,
Yes.
although in practice it does, but at base it doesn't necessarily require those. And so the ways in
No.
which those points of centralization spring up can be seen as a voluntary bottom-up process rather than anything imposed top-down. Ethereum can't make that claim.
Yes. Generally speaking, with Ethereum, with proof of work and proof of stake, I'm generally on the side of the proof of work side, even though it gets so much hatred. Because with proof of stake, where the network functions effectively from large stakeholders, repeatedly proving their stake, proving that they own this much, and using that to help secure the network. There was this metaphor that I remember reading several years ago, and it just stuck with me, where proof of stake is very much like the current financial system as it is, where if you have enough capital, you end up being able to make the rules on the network. Right, so you don't actually have to do the work, like in proof of work, where you have to, where you're effectively just exerting effort in order to gain a reward. You simply have to hold and stake capital in order to change the rules. And that was why I've generally on the side of Bitcoin. Ultimately, Bitcoin is the most successful that we've seen thus far in the crypto space. So of course, that may change. A lot of people in crypto, interestingly, are awaiting the grand flippening once again, where Ethereum will overtake Bitcoin's market cap. Very exciting for people who love turf wars within crypto. But it is a very interesting dynamic. I think ultimately, though, Ethereum and Ethereum is still going to act a bit more like leveraged Bitcoin. That's just my view in general. Now, moving on slightly, I think we could probably shift right now, before we do a few more questions, to our long-short segment. Now, for those who haven't watched this show before, this is where myself and John take a look at the news flow that we've seen this week. And we take an asset, a behavior, a strategy, or just an anomaly, and we say whether or not we're bullish on it. We think we're going to see more of that in the future, or we're bearish on it. So if we're long or we're short. So our longs are the things that we think we're going to see more of, and our shorts are the things that we're going to see less of. John, what is your long for this week?
Well, actually, my long is going to be one that I've mentioned more than once, but I'm feeling particularly good about it now, and that's gold. It depends. We already spoke about charts, momentum, and whatnot. When I look at the chart, when I look at the momentum figures, et cetera, looks like gold's putting in a floor here. And I think when you look at the macro fundamental environment, gold has every reason to be substantially higher than it currently is. And indeed, that even allows for the Fed to be raising interest rates, because real interest rates in dollar terms are incredibly negative at levels that do imply a significantly higher gold price, north of $2,000 for sure, than we see today. So when you combine the macro fundamental supportive context with the recent price action showing gold trading substantially better, both outright and vis-a-vis certain other commodities, I think gold is a buy here.
Yes, it does feel like gold is shrugging off some of the bad weather that's had over the past year.
You can throw silver in too. I think gold's the safer bet, but I have no problem splitting that trade between the two.
On that note, we actually there are a couple of comments in the chat which I think apply very well to this and why one would be holding gold. So Jeffrey comments: investing in currencies is like rearranging the chairs on the Titanic. which I think is a very apt description. And Mike, who says, I was thinking cash is bad to hold just now. Well, considering the amount of inflation data we've seen, I would feel pretty nervous if I had an awful lot of cash, like Robert, for example. But that's just me, because still, ultimately, if you hold lots of cash, and the price of the assets that you want to buy, they go down enough. It doesn't matter that inflation is high, provided you can buy those assets on the cheap.
Oh, look, I mean, there's nothing wrong with holding a tiny bit of cash, but the problem is we're in this environment now where the cost, the negative carry implied by that amount of cash is unusually high. When you get into a really low zero or negative interest rate environment, sitting on cash waiting for a rainy day is simply not a viable investment strategy anymore. You really do have to deploy it. The question is how. And obviously, you can just diversify it as widely as you possibly can. But in an environment like this, with outright negative real interest rates, you really do have to deploy your cash, unless you're absolutely convinced that a crash in one or more asset markets is imminent. But come on, I mean, who really has that level of confidence? So now that said, let's say, for example, you have some longer dated liabilities, but for some reason you don't think those liabilities are going to rise with inflation, but remain fixed. Well, okay, then fine. If you're sitting in cash in a way, it doesn't matter. You can still meet your liabilities. But the vast majority of us have liabilities which we assume over time will rise with inflation. And sitting around in cash, matching those liabilities is a very dangerous game to play. So you really are kind of forced to be invested in this environment. Now, that said, that doesn't necessarily mean you're forced to invest in a risky way, but you're definitely forced out of cash. You really are. You can't just sit in cash the way things are now.
It would be a tricky position to be holding. I mean, I think I'd be looking at it and the inflation data whenever it comes out, regularly throughout the year, and calculating each time just how much value I've lost. Though even inflation data now is something that's, well, now, I mean, it's always been something that's rather tricky to know whether or not it's truly accurate. John, in terms of my long for this week, I think my long, this is a bit of a cop out, really. I'm long house parties this week. That's my. I just think house parties are.
How do you get long house parties, Boaz?
Well, I've always loved a good house party. I think in many ways a decent house party can.
No, I mean, how do you invest in it?
Oh, well, you can host one yourself, can't you? Though I think you're probably going for shop bought alcohol would be the play. So you'd be looking at the grocery stores and some of the booze companies that don't sell their wares to bars and just specialize in the shop bought stuff. So that'd be what I'm feeling long on this week. Right. But yeah, there can't be a good house party, and I know I'm not the only one out there. So what would be your short for this week, John?
Yes. I'm going to stick with commodities here. Basically, I think copper is now an accident waiting to happen. If you take a look at a chart of the copper price, basically copper has been trading into this pennant formation. It's getting narrower and narrower and narrower, but at an elevated level. Unlike other industrial commodities such as iron ore, coal, even oil now has rolled over a bit. Copper is just hanging there at an elevated level, not far off its highs from earlier this year. That doesn't sit well with me. And if you look at the forward curve for copper futures, it's as flat as a pancake. So there's no positive carry in sitting on that position. And indeed, if the Fed does raise rates, then any position that is not generating positive carry immediately becomes more negative carry to hold as a result. So I think copper is just the wrong price, and I don't know why it's stuck. It looks increasingly curious, but fundamentally and technically, it looks like it's going to break lower imminently. So I would pair up a long gold and silver on the one hand and short copper. I think it's a really good trade here.
That's interesting. Do you think the action in copper is? Do you think the market fears more lockdowns or anticipates more lockdowns, which would lead to lower copper demand?
Well, I really don't think this Omicron thing is being taken seriously by the market anymore. I mean, there was the brief scare, but equities just got back in gear again. I really don't think, and the more data that comes out just confirms what we kind of suspected early on, which is that Omicron may be uber contagious, but it's just not resulting in hospitalizations increasing anywhere. And indeed, in South Africa, where apparently it was prevalent weeks before it showed up anywhere else, they're already giving the all clear, saying, we're comfortable now that no return to lockdown is necessary, and that's where it began. So presumably they're ahead of that curve.
Yeah, you certainly hope so, and you certainly hope that somebody would tell the prime minister. But I'm not. I'm not the most confident in that. We do have a question from Robin on your short, actually, John. Would you prefer to short high grade copper or regular copper? Would you distinguish between them?
Well, look, all I have experience trading personally is just the benchmark contract that trades on the COMEX, the HG contract, right? I mean that is the benchmark. That's where most of the liquidity is. Of course, you have other grades of copper that I think you have multiple grades that trade on the LME. I've never traded LME contracts, so I'm not familiar with those. So I guess what I'm saying is whatever that HG contract grade is, and I'm trying to recall what it's high. I mean, but it's not uber high.
Yeah.
I'm trying to think what it is. Is it 90, 95? It's somewhere up there, right? You can find it on the CME's website. They specify the minimum qualifying grade that will clear that contract physically.
Yeah, I mean, I would assume that it's the benchmark that it'd be the regular stuff that Robin is referring to, but
I think so.
Yeah. Now, Bruce says, give Omicron a little time, and maybe the governments are going to, maybe they'll get even more stringent on lockdown rules. I've yet to see what the new regulations are going to be in England. I'm not sure if they've been released just yet, but yeah, we'll have to wait and see, because really, I think given how we had over 2020, 2021, different governments did things completely differently. So even though some of the data might have been the same, ultimately it was the government's response that was more important if you're an investor, rather than what the virus was actually doing and the way it was manifesting itself in the data. So I do feel like we still need to wait and understand how government's going to react to it, rather than focus so much on the data. Because if you focused only on the data in, say, 2020, I don't think you would have been able to get an edge in the market. And of course,
look, and that's the thing, right? I mean, don't get me wrong. I don't want to belittle Omicron completely. I'm just saying that there's no evidence yet to support the view that this should result in heavy-handed lockdowns. It's just it's just not there. Whereas we had a very, very scanty data set in early 2020, no one really knew what we were dealing with. We're in a very different place now. But yeah, let's keep in mind. I mean, somebody who was clever enough to realize that Swedish retail was going to hold up a hell of a lot better than retail in some other countries, that would have been a decent trade. And so we're still in a situation where, yeah, if you think where governments, for whatever reason, are going to be really heavy-handed about this, do you want to be long those retail and leisure sectors or tourism to those locations? I mean, do you want to be long New York tourism when a family can't bring in a child over 5 years of age without them needing to get vaxxed just to visit the museums? I mean, that's going to turn people off, right? So you can apply that logic around the world, I suppose. And try to predict, which governments are going to, get really strict about this and which are going to be more relaxed about it. There might well be some trades in there.
Certainly. Jeffrey comments, my whole family in South Africa has Omicron. So far, no serious symptoms. Seems like a milder version of COVID. Well, Jeffrey, I hope they do get better soon and that there are no long-term side effects of it. Of course, we ultimately don't know, similar to, and everyone has different responses to it. I had a couple of friends who lost their sense of taste and smell, and whiskey apparently just tasted like oily water. Didn't burn at all, which I thought was interesting. If you ever had some spirits lying around that you hated the taste of, probably a time to get through it while you could. We are getting on a little bit for time. My short for the week, by the way, is Twitter this week. We have had a big change in CEO. And I think it's just today, there was a very good Twitter account called Nancy Pelosi Portfolio Tracker, which was a satirical account based on the Nancy Pelosi's, the trades that she's made. She is a very, very good investor. Nancy Pelosi over in the States, the Speaker of the House in America, and has made a vast fortune through some very shrewd trades. And one does wonder whether or not she was somehow ahead of the game. She had inside dope on what the markets might be doing. And anyway, this account was just making fun of it. Anyway, that account has been suspended, as I believe as well as the Ghislaine Maxwell trial tracker account has also been taken down today. And it's ultimately, I don't think this is going to be very good for Twitter if they keep getting this image that whenever someone says something controversial or is maybe speaking about powerful people in ways that they don't like, that they get silenced, because I don't think that was quite the original spirit of Twitter. Now, we are getting on for time. Sadly, we can't have quite so many, we can't last quite so long as we did last week, folks. So just in general, I think we can cover maybe a couple more comments. If we're looking at euro dollar, has it bottomed yet? Now, what's the name for that currency pair, euro dollar? Is that fiber? Was that the slang nickname for that currency pair, euro/dollar?
Oh, I haven't heard that term, actually.
Oh, I thought it was fiber. Yeah, it was the fiber optic cable.
No, it's cable. Cable is the slang term for sterling.
Yeah, sterling dollar.
Sterling dollar.
So I thought euro dollar was called fiber.
Oh, okay. Well, sorry, I don't. I mean, maybe it is, but I would always have just said euros.
Just said euro dollar. Yeah. But just in terms of your view on euro dollar, would you say that's bottomed yet, John? It's quite specific again, and of course we don't give investment advice. Just a general view on the value of the euro relative to the dollar.
I believe the dollar is fundamentally overvalued. Now, that said, anything that's fundamentally overvalued, I mean, there's a reason why it gets to where it is, and there has been a view which has been very popular so far this year. That the U.S. would be leading the interest rate cycle, and that the ECB would not, and that for that matter, also the Bank of England would not, and that has been supportive for the dollar, and we remain in that sort of environment where that does appear to be the general anticipation. But I believe the dollar is fundamentally overvalued vis-a-vis the rest of the world, and there are a variety of reasons for that. Now, the U.S. has a huge net external debt position. The U.S. needs, I believe, about $2.5 billion of foreign capital every day to cover its current account gap every single day. And at current interest rate differentials, there's no reason to do that. So it's purely speculative flows, as it were, people believing for whatever reason that U.S. assets are going to outperform the rest of the world going forward. But as we mentioned before, the U.S. equity market looks expensive relative to the rest of the world. You have to have relatively optimistic growth assumptions for the U.S. and for U.S. corporate profits vis-a-vis the rest of the world. And while once upon a time you could have said, oh, well, the U.S. economy is more dynamic and more capitalist and less regulated, and I'm not sure that's true anymore. I mean, look, the average tax burden in the U.S. is no longer materially lower than that of many European countries. Yeah. And indeed, if you want to find low tax burdens around the world, you kind of have to go to Asia now, and a few pockets here and there where tax rates are at levels that used to be normal in the U.S. if you go back a couple generations. So no, the U.S. is no longer a low tax country. It's no longer a low regulation country. And yet it's one that is overvalued vis-a-vis the rest of the world. That to me does not justify the dollar being where it is. And the simplest way to make that adjustment is for the dollar to weaken. And indeed, I've done some back of the envelope calculations. The dollar would need to decline in trade weighted terms. So versus all major currencies, The dollar would need to decline by roughly a third to remove the United States' chronic need to rely on foreign capital to keep its net foreign debt position rolling over.
Well, that would be one hell of a move.
Yep.
John T, who asked that question on euro dollar or fiber, has it bottomed yet? I hope that does answer your question. Now, folks, I'm afraid we have gotten to the end of our time for this evening. Thank you so much for tuning in to Southbank Live episode 23. I hope you'll tune in next week. Don't know if it'll be Wednesday or Thursday. I think it'll be Thursday evening when we shall be back next week. But that's all from us for the moment. So thank you so much for tuning in. As again, do give a like and subscribe. If you're watching a recording of this, do feel free to leave a comment below this video with a question or indeed a future theme that you'd like us to discuss on the show. But John, that's all from us for the moment. Thank you so much for joining me.
Thank you, Boaz. Until next time.
There you have it, folks. We'll see you next week. Bye-bye.